When I first began researching the world of early retirement, I truly believed the biggest threats would be the same issues everybody constantly warns about. You hear the conversations everywhere, right? Rising inflation, stock market volatility, sequence of returns problems, or even the challenge of finding purpose and staying busy after leaving the workforce so you don't end up annoying your partner all day long. But the deeper I dug into the data, the more I realized that the single biggest financial danger facing early retirees in 2026 has almost nothing to do with investing at all. It is healthcare, and the impact could be enormous. Most of us grow up believing in the classic American retirement dream. You spend decades working hard, steadily growing your savings, and eventually walking away from your career to finally enjoy your freedom. But if your goal is to retire before age 65, the point when Medicare eligibility finally begins, the entire financial landscape is shifting so dramatically that it could completely reshape your future. We are talking about a reality where the exact same insurance policy, with the exact same doctors and benefits, could either cost you a very manageable $5,000 annually or an unbearable $28,000 per year. Seriously, think about that for a moment. And the difference between those two outcomes has nothing to do with your medical condition or where you live. It all comes down to how carefully you organize your taxable income and your tax return strategy. So grab your favorite drink, get comfortable, and stay with me because today's explainer goes deep into this issue. We are going to break down exactly what changes in 2026, why this legal cliff exists, and most importantly, how you can legally shield your retirement savings from getting drained by crushing insurance premiums. Picture this situation for just a moment. Imagine waking up one morning and realizing that simply leaving your job has automatically triggered an annual healthcare expense equal to the cost of buying a brand new vehicle, and now you owe that amount every single year. For millions of middle-class Americans between ages 50 and 64, that possibility is becoming very real. During my research, I came across the story of a woman named Susan, and honestly, her experience perfectly demonstrates how serious this problem really is. Susan worked as a high school teacher. She dedicated 22 years of her life to educating students and doing everything responsibly. She saved consistently. She finished paying off her house. Emotionally, she was completely prepared to retire and begin the next stage of her life. One Sunday morning, she sat at her kitchen table feeling optimistic about her future and decided to check healthcare.gov just to estimate what insurance would cost before Medicare started. She entered her expected retirement income, clicked calculate, and suddenly found herself staring at a projected annual premium of $28,000 if she retired before turning 65. $28,000. The second she saw that figure, her stomach sank, and she honestly believed she would have no choice except to remain teaching for another 7 years simply to afford health coverage and basic protection. And the shocking reality is that Susan is far from alone. Healthcare expenses are quickly becoming the #1 obstacle preventing hardworking Americans from enjoying the early retirement they earned after decades of labor. And when you zoom out and look at the long-term numbers, things become even more alarming. $180,000. That is the potential total cost during an 8-year gap before Medicare eligibility. Think about it carefully. If you retire at 57, you are personally responsible for 8 full years of health insurance before Medicare begins at age 65. If your annual premium lands near $28,000, or even slightly lower depending on inflation, you could easily spend close to $250,000 just on healthcare coverage alone. Put that into perspective for a second. That amount of money could have purchased a luxury travel trailer, a peaceful mountain retreat, or financed years of traveling around the world. Instead, it disappears simply to maintain an average middle-tier health insurance policy. And once a bill that large hits a fixed retirement income, it destroys flexibility almost instantly. Your fun budget disappears. Travel plans vanish. The kitchen remodel you dreamed about gets canceled indefinitely, and your health insurance suddenly feels like an extra mortgage payment. Except unlike a mortgage, this is one you never intentionally signed up for in the first place. So clearly, you need a practical roadmap to survive this transition. Here's our guide for today's explainer. First, we'll examine the 2026 subsidy cliff. Second, we'll decode the MAGI formula. Third, we'll explore the COBRA bridge strategy. And fourth, we'll discuss how to properly prepare your Medicare bridge years in advance. Okay, let's move directly into Section 1, the 2026 subsidy cliff and the return of the hard income cutoff. Honestly, I had to reread the legislation multiple times before I believed what I was seeing. But the government truly created a hard, unforgiving line directly inside the tax code. To understand the risk, we first need to compare how the Affordable Care Act currently operates versus what happens beginning in 2026. Since 2021, temporary legislation dramatically expanded ACA marketplace subsidies. There has been a generous rule limiting premiums to 8.5% of income. Because of this, even higher income early retirees, including households earning well above $150,000 annually, could still qualify for significant government assistance. But everything changes on December 31st, 2025. Those expanded subsidy rules expire completely. The system reverts back to the older structure where assistance disappears abruptly after income exceeds a specific threshold. This is what financial professionals call the subsidy cliff. Here's the basic concept. Every year, the government sets income guidelines tied to household size called the Federal Poverty Level, or FPL. For a married couple in 2026, the estimated 400% federal poverty limit will likely land near $84,600. Now here's the truly frightening part. If your reported income stays slightly below that line, maybe around $84,000 exactly, your Silver Tier ACA plan remains heavily subsidized and costs roughly $5,000 for the year. But if your income crosses that threshold by even a single dollar, you lose the subsidy entirely. All of it disappears instantly. There is no partial assistance and no gradual phase-out. No warning arrives in the mail. Your premium immediately jumps from around $5,000 annually to nearly $28,000. It's like receiving a tiny raise at work only to get slapped with a gigantic financial penalty moments later. And once you combine those lost subsidies with higher deductibles and larger out-of-pocket limits, the effective cost of earning a few hundred extra dollars can resemble a terrifying 60% marginal tax rate. It becomes a financial trap waiting for anyone who is unaware. Now let's continue into Section 2, understanding the MAGI formula. Because in this system, what matters is not how much you spend, but what income you officially report. Here is where the real strategy begins. To avoid falling into that brutal, effective 60% tax penalty we just discussed, you must fully understand the exact formula used by the government. And this realization completely changed the way I viewed retirement planning. The healthcare system honestly does not care about your total net worth. You could own a paid-off mansion and have $5 million sitting in investment accounts while still legally qualifying for large ACA subsidies. On the flip side, you could have almost no savings at all. But if you receive a large pension payment each year, your healthcare costs could become financially devastating. So what number actually matters? MAGI, which stands for Modified Adjusted Gross Income. This is the single number used by the ACA marketplace to determine subsidy eligibility. And here is the part that confuses many intelligent people. Unlike your regular federal tax return, The ACA formula does not allow you to subtract the standard deduction from this number. Think about that carefully. Married couples currently receive nearly $30,000 in standard deductions on their normal tax returns, but ACA calculations force you to add that amount right back into your income calculation. You must also include tax-exempt Social Security income, foreign earned income, and tax-free interest payments. It basically operates like a completely separate tax universe with its own unique rules. Because of this, your healthcare MAGI can easily end up much higher than your normal taxable income. These unusual rules mean you must begin viewing your retirement assets in two categories: accounts that are toxic to ACA subsidies and accounts that are safe. Let's start with the toxic category. These are income sources that fully count toward MAGI calculations. Withdrawals from traditional IRAs and 401ks, pension checks, full Social Security income, and standard dividend payments all count directly against you. But the biggest surprise for me was municipal bonds. Financial advisors constantly describe municipal bonds as tax-free income champions, right? And technically, they are federally tax-exempt. But for ACA subsidy calculations, the government still counts municipal bond income against your MAGI. So if your brokerage account produces $30,000 annually in municipal bond interest, you are already dangerously close to the subsidy cliff before even touching your principal savings. It's unbelievable. Thankfully, the other side of the equation contains your protection tools. These are the safe accounts that remain invisible to MAGI calculations. Roth IRA withdrawals do not count at all for ACA purposes. Spending your original cash savings principal also does not count because that money was already taxed years ago. HSA funds used for qualified medical expenses are invisible too. To survive the subsidy cliff successfully, you need to intentionally build these safe buckets while you are still working so you can later finance your lifestyle without triggering higher MAGI levels. So what does this strategy actually look like in real life? Let's return to Susan and her husband Tom because they successfully used this exact method to protect their retirement. Remember, Susan originally thought she needed to continue working until age 65 because of that terrifying $28,000 healthcare quote, but after carefully coordinating their withdrawals, they managed to maintain their desired $140,000 lifestyle without sacrificing anything. They wanted a comfortable retirement full of travel, and they achieved it. Here's exactly how they structured it. They withdrew $40,000 from a traditional IRA, which counted as taxable income. Then they realized another $20,000 in capital gains from investments. Together, their official MAGI totaled exactly $60,000. That amount stayed comfortably under the estimated $84,600 subsidy cliff. But obviously, $60,000 was nowhere near enough to support the lifestyle they actually wanted. So where did the remaining money come from? They funded the rest by withdrawing $50,000 of already taxed cash principal from savings and another $30,000 from Roth IRA accounts. Since both of those sources remain invisible to MAGI calculations, their reported income stayed at only $60,000, even though they actually spent $140,000. Because their MAGI stayed low, their annual healthcare premium dropped from nearly $28,000 down to approximately $400 per month. That simple decision about which accounts they withdrew money from ultimately saved them more than $180,000 during their 8-year bridge to Medicare. It's incredibly smart planning. Now let's transition into Section 3, the COBRA safety net and why it acts like a legal waiting strategy. Imagine you retire halfway through the year, maybe sometime in June. You probably do not want to jump directly into an ACA marketplace plan immediately. especially if your first 6 months of salary already pushed your income far above the subsidy cliff. You need a temporary bridge to the next tax year. Interestingly, even tennis superstar Venus Williams faced a similar challenge and relied on COBRA coverage during a career break, proving that stable healthcare matters for everyone regardless of wealth. During one extended hiatus from professional tennis, Williams needed continuous treatment for her autoimmune condition, Sjogren's syndrome. Changing doctors or losing specialist access simply was not an option. COBRA exists specifically to let people continue their existing employer healthcare coverage after leaving a job. Now, to be clear, COBRA is not cheap. You pay the entire retail premium yourself because your employer no longer contributes. That often means paying 102% of the full premium amount. However, because it is the exact same insurance plan you previously had, it often includes better networks and lower deductibles than standard ACA marketplace plans. And here is the incredible feature most people never hear about. COBRA includes a retroactive election period that effectively creates a 105-day decision window. Imagine if you could buy car insurance after already getting into an accident. Sounds impossible, right? But this law creates something remarkably close to that for healthcare. Here's how it works. Once you leave your job, you receive 60 days to decide whether to elect COBRA coverage. If you wait until day 59 to enroll, the law then gives you another 45 days to actually pay your first premium. Altogether, this creates roughly 105 days, where you technically remain uncovered, but still possess a legally protected option to retroactively activate coverage if something major happens. Let's say you break your leg hiking on day 50 and suddenly need surgery. You simply submit the COBRA paperwork, pay the back premiums for those previous months, and your hospital bills become covered retroactively as though your insurance never ended. Never. On the other hand, if you remain perfectly healthy during those 3 months, you simply never activate COBRA and save yourself thousands in premiums while waiting for ACA open enrollment. It's an extremely powerful strategy for people comfortable with the risk. Of course, if you eventually activate COBRA after an emergency, the monthly premiums can still be extremely expensive. But there is a major tax advantage many retirees completely overlook. Let's quickly discuss health savings accounts, or HSAs. HSAs normally provide a triple tax benefit. Contributions go in tax-free, investments grow tax-free, and withdrawals remain tax-free when used for qualified medical expenses. But under normal IRS rules, HSA funds cannot usually pay monthly health insurance premiums. However, COBRA is one of the rare exceptions. IRS regulations specifically allow HSA money to pay COBRA premiums tax-free. Because those HSA contributions originally entered the account pre-tax, using them for COBRA effectively creates a discount equal to your previous tax bracket. In practice, that means your COBRA premiums may effectively cost 20% to 30% less than they otherwise would have. It's a huge advantage that surprisingly few people fully understand during retirement transitions. All right, let's tie everything together with Section 4, planning your Medicare bridge and preparing today for tomorrow's rules. Simply understanding the subsidy cliff and MAGI calculations is not enough. You need to position your assets properly now while you are still employed, so you have those invisible safe buckets available later. If all your retirement savings sit entirely inside traditional 401ks and IRAs, escaping the subsidy cliff becomes almost impossible because every withdrawal counts directly toward MAGI. Think of this preparation process like renovating a kitchen. It may feel expensive and inconvenient now, but doing the work up front creates years of comfort and financial stability later. Step 1 is auditing your MAGI exposure. Carefully review your investment accounts. If you hold mutual funds generating heavy dividends in taxable brokerage accounts, consider moving toward tax-efficient growth funds instead. Step 2 involves harvesting capital gains strategically while still employed. If you own appreciated investments, selling them now resets your cost basis and reduces future taxable gains during retirement. Step 3 is perhaps the most important strategy of all: Roth conversions. Imagine you are age 62 and plan to retire next year while currently sitting inside the 24% federal tax bracket. Traditional financial advice constantly says delaying taxes is always best. But if retiring pushes you over the ACA subsidy cliff and exposes you to a 60% effective penalty, voluntarily paying 24% taxes now becomes a brilliant long-term decision. By converting traditional IRA money into Roth accounts before retirement, you create a large tax-free withdrawal bucket for future years. Then once retired, you can draw income from those Roth funds without increasing MAGI and safely preserve your ACA subsidies. Now, despite the scary subsidy cliff, 2026 also introduces several positive healthcare changes that provide additional flexibility. Recent legislation does not only focus on subsidies, it also expands consumer-friendly healthcare tools. For example, dependent care FSA contribution limits are finally increasing from $5,000 to $7,500 for the first time in decades, providing overdue relief for families facing expensive childcare costs. In addition, telehealth safe harbor rules are becoming permanent. This means people enrolled in high-deductible health plans can continue receiving virtual doctor visits before meeting their deductible without losing HSA eligibility. And finally, direct primary care memberships are no longer disqualifying for HSAs. Direct primary care works like a subscription service for your doctor, where you pay a monthly fee for ongoing access. Previously, the IRS treated those fees as a second health plan, which disqualified HSA participation. Beginning in 2026, you can finally use HSA money directly for those membership costs, modernizing the way many Americans access routine healthcare. So where does this leave us? We spend decades obsessively building retirement savings. We track our investment balances constantly. We monitor the market and naturally assume our total net worth represents our ultimate financial safety net. But as we explored today, a hidden technical rule buried deep inside the federal tax code can potentially erase hundreds of thousands of dollars from your retirement savings simply because you withdrew money from the wrong account. That reality completely changes the definition of financial independence. It raises an incredibly important question about modern retirement planning. Could the structure of your income strategy actually matter more than the total size of your savings account? Understanding the 2026 subsidy cliff is not just about lowering insurance costs. It is about protecting yourself from being punished financially for accomplishing the retirement goals you worked decades to achieve. Thank you so much for spending this time with me during today's explainer, and I strongly encourage you to examine your own retirement buckets carefully before these rules officially change. Start preparing now and protect the future you worked so hard to build.